Welcome to the Chinchilla Picking Podcast. I'm by myself today. There is no Dave Underwood to rein me in, which is kind of exciting for me, but I don't know if it's good news or bad news. Just staring at myself right now, which I kind of like it. I like that. But at the same time, nobody to rein me in. So if I go on rants, you're pre-warned. I apologize. Crazy week in the market, rally over the CPI number, 8.7% inflation, hardly anything to celebrate. Of course, it's down from 9.2%, but still a long way to go. Still a long way to go to the Fed's target of 2 to 3%. We still don't know what the devil of deflation really looks like. We've seen the devil of inflation. Now we're going to get to the devil of deflation. Maybe, I don't know. It's a little too early for us to take a victory lap on this and say that inflation's over. A couple of months ago, I started kind of detailing what I was seeing that could possibly be signs of a top for inflation, the tech bubble cooling down and really popping in many cases. You see a lot of tech companies with negative earnings. Their stocks have been just clobbered. And we told you this was going to happen. I told you this at the end of last year, that you really needed to be more picky with the stocks that you were choosing. Your Apples, your Microsofts, even your Amazons. Amazon's a little bit more overvalued now after the last earnings report, but I think it's justified. I think you could buy those stocks and just hold on to them. Those are fine. The ones with the positive earnings that have created their empires already, that have the mountains of cash, like Apple's got the $95 billion of cash on hand. Those companies are going to be okay. They will come out on the other end of this just fine. Your other companies, your Pelotons, even your Rivians, not so much. Speaking of Rivian, the electric vehicle for soccer moms, lost $1.7 billion in the second quarter, driven primarily by an increase of $1 billion in operating expenses. See, inflation really hurts companies that do not have positive earnings already and that aren't able to absorb those costs of supply chain constraints, new higher raw material costs, and things like that. Ford is doing okay. Ford's stock has been on an absolute tear for the past month or so. Rivian, not so much. Hold on, I got to put my glasses on. My Clark Kent disguise. You'll see it if you're watching our YouTube channel. Anyways, the EV maker lost $1.89 per share. Revenue reached around $364 million. Compared to last year, they had no revenue at all. And the revenue increase, $364 million, still does not justify the stock price right now. But anyways, this is mostly because of the delivery of 4,467 vehicles that I assume are now driving kids to soccer practices with "Can I speak to your manager?" bumper stickers. Rivian first hit the market on November 10th, 2021 at $106.75 a share and is now trading at $38.01 a share as of me recording this podcast. What a decline. What a decline. And it shows that you, like I said, you really had to be picky about the stocks that you were buying this year. I knew many people that thought, oh, Rivian, new EV company, let's just buy it because that's, it's a new EV company. It's hot and it's trendy. And, the soccer moms love it. But obvious, huge decline here. If you're going to go individual stock picking, you have to pick the good ones. And you've got to pick companies that are going to live up to their valuation. So Rivian is not doing that so far. Rivian, the electric vehicle version of the Karen haircut, guided down for the rest of 2022 and now expects a loss of $5.45 billion, down from their previous guidance of $4.75 billion loss. And this is primarily due to supply chain challenges and higher raw material costs. Now, moving on to another company. Now, here's one that I said, I couldn't find the episode that I said it on, but it was a couple months ago that I said, Disney, buy the stock, put it away, don't look at it. And this is, to me, Disney is right there with Apple. It's right there with Microsoft. You buy it, you put it away, you don't look at it. It's been that way for like as long as I can remember. I'm 36 years old right now, and I cannot remember a time in which it was not a good idea to own Disney. Their media and entertainment distribution represents 65.6% of the company as far as revenue goes. Parks, experience, and products and revenues from those things represents about 34.4% of the revenue. I expect that the parks and experiences portion of this company is going to increase as far as its share goes. I think that you're going to probably see this go up to probably about 40%. So it'll be about 60% media, entertainment distribution, and parks and experience and products is going to probably be around 40%. The reason why I say that is because Disney Shanghai, Disney Hong Kong, and other international Disneys had been closed for 2 years. And as of June 30th, with the reopening of Disney Hong Kong and Disney Shanghai, all of the parks are now open. So I expect that the parks revenue is going to contribute much more than what it has been. They said higher revenue is being seen by the parks on a day-to-day basis when compared to 2019. And that's important, okay? Because in 2019, and this was pre-Disney Plus, Disney had $15 billion in operating income for the year. Over the past 12 months, they've only had $5 billion in operating income. So we expect that operating income is going to continue to increase. If you looked at the price to earnings for Disney right now, it's about 80. I expect the stock will probably continue to go up a little bit, and that price to earnings will come down at the same time because the earnings are going to increase pretty dramatically over the next year, without any new pandemics or anything like that. Domestic revenues were 5.42 billion. This was significantly up from $2.66 billion a year ago. International revenues also increased 49.8% year over year to $788 million. And this is going to continue. This is why people are paying up for it right now, according to that price to earnings ratio at 80%. It's because they fully expect that to normalize. Meanwhile, the stock can continue to go up. Another stock that I say, buy it, hold it, put it away. Don't look at it. Berkshire Hathaway. Even after slipping to a loss of over $43.7 billion in the second quarter. Now, they had a profit of $28 billion in the same quarter of 2021. So that seems really bad. I mean, that's about a $70 billion swing to the negative side. But the loss is being attributed to the stock market decline. Now, Berkshire includes those unrealized gains and losses in their earnings. They have to. It's an accounting rule. So when you see that right now, I mean, look at this is another thing that happens with these ratios that goes kind of crazy. Berkshire Hathaway's price to earnings ratio now is around 50. It was like a couple of months ago, it was much lower than that. This is a one-off situation for Berkshire Hathaway with the stock market decline that happened over the second quarter, increasing those losses. Operating earnings, on the other hand, rose by 39%. This was boosted by Berkshire's powerful insurance division. Operating profits came in at just above $9 billion. So you've got a $43.7 billion loss of stocks that actually Berkshire never sold. So it's not really a loss, it's just unrealized loss. And a $9 billion gain from operating profits, mostly from their insurance. I'm still saying buy the stock. I'm 100% saying buy the stock and just sit on it. Now, and I'm just going to quote I'm going to quote Warren Buffett here. We said, the amount of investment gains and losses in any given quarter is usually meaningless and delivers figures for net earnings per share that can be extremely misleading to investors who have little or no knowledge of accounting rules. 100% agreed here. 100% agreed here. And even if the stock market continues to sway and have high volatility, as I expect it will, Berkshire still buy. And to me, if it goes down in value, you just buy more. You just buy more. Berkshire's got $105 billion in cash on hand. They will also be just fine. Okay. Now, what won't be fine is your meme stocks, your Bed Bath and Beyond. I mentioned Bed Bath and Beyond on a podcast. I don't remember if it was last week or the week before, but almost immediately, the meme stock traders must have been listening to me because the thing just went wild. It increased in value again. It went crazy, and I just have to say this. Listen, if you're trading the meme stocks and you're doing it on a short-term basis, you're taking your 5, 10, 15, even 20% gains here and there, and you're selling to take those gains. Fine. Okay, fine. I'm okay with that. It's the people who are holding because they have diamond hands. You're gonna hold that. You're gonna die on that mountain. Okay, don't die on that mountain. I will never die on a mountain investing in anything. Okay, I was pretty heavy on the China thing last year. It was a big mistake for me. I did not die on that mountain. I did not put so much of my money into Chinese stocks that I would die on that mountain. It didn't happen. I'm still here. I still beat the S&P 500 last year. And those Chinese stocks have earnings. Okay, your Bed Bath and Beyond, GameStops, they don't. You're going to die on the mountain. You do not, as a retail investor, you do not have enough liquidity to keep that thing high for forever. And I am fine being wrong on this until I'm right, because that's what's going to happen. This meme stock phase is, I mean, it's new. It's a new thing. It's a new thing that's happening in the market to a certain extent, but the stock market is just riddled with a history of people who thought they reinvented the wheel and that they could buy these companies that have no earnings whatsoever and continue to make so much money off of it. And these people have always thought that they are the most intelligent people in the world until they weren't. Until they lost it all. So I'm talking to the diamond hands people of GameStop and AMC and AMTD or whatever stock you want to add to it. I heard Wayfair was on this list, which that kind of blows my mind because to me, Wayfair, they're victims of a potential recession. High inflation's really eating their earnings. But if you want to take a bet on Wayfair and a turnaround, I'm actually okay with that. So for this to be included in the Wall Street bets thing, it kind of threw me off a little bit because Wayfair's got a price to sales of less than 1 right now. And I mean, I wouldn't put a ton of money into it at all. I wouldn't, because I'm really concerned right now with the devil of deflation as well as the devil of inflation. I think that a lot of speculators dropped out of the oil market, and that's why you saw commodities take a dive. And I'm not certain that is permanent. I'm not certain that we're not going to see an increase in oil prices again. In fact, I think a lot of people are kind of betting on that. I mean, Berkshire Hathaway putting $10 billion into Occidental Petroleum again. I mean, Warren Buffett, probably the most intelligent investor ever. He seems to be betting that oil prices will go back up. I wouldn't want to bet against him. I mean, will it happen? I don't know. I'm not Miss Cleo, as I like to say, but I wouldn't bet against it, is what, And if you're really worried about inflation, you think we've peaked here, the devil of deflation is right around the corner. And even if we do have a soft landing, which I doubt we will, it's never happened in the history of the United States. We've never gotten this high in inflation and had a soft landing. And every time I've heard it's different this time, it turned out to not be different this time. And we've wound up in a recession, and a pretty deep one. So even if it doesn't happen the fear of it happening will exist and it will permeate through the market. And I'm betting that prices will come back down. Now, I haven't sold a single one of my core positions at all, and I don't plan on doing it. And the reason why is that I stick to my guns on this. I say you buy good companies at good values, and you're really lucky if you can get great companies at a price to book of below one and a price to sales of below one. Sometimes below that. Disney is I think a price to sales of around 2, price to books. I don't know what price to book is. I'd have to look at it, but those ratios are a bit inflated. But using 2019 numbers and then saying that, okay, we're going to increase over 2019, which is what they're saying they're going to do, then I think that Disney's still a good value. But nonetheless, I'm rambling here. And see, this is where Dave would reel me in, but Dave's not here, so I can see prices in the stock market come down. So I'm telling you, don't chase this dragon right now. Now, one thing that you can do if you're as concerned about these things as I am, but you still want to invest your money, but you don't want to pick individual stocks. Say, for example, if you're somebody that has a full-time job, like most of us do, and maybe you got a family, maybe you got kids, things like that, and you just don't have the time to go through the earnings reports of Apple or Microsoft or Disney or whatever, then what you could do is you can buy all of them, right? You can buy the S&P 500. You can do it through an index fund. And the best way to do that with the lowest cost expense ratio is SPY. Me and Dave talked about this 1,000 times. And what a really good way of investing into SPY is to say you've got a certain amount of money. Maybe it's $10,000, maybe it's $20,000, maybe it's less. I don't know. You just divide it up and say, you buy it once every year on the exact same date, or exactly every 6 months, or maybe every quarter. Maybe you do it every 3 months, and you don't back down from it. Doesn't matter if the stock market's high, doesn't matter if the stock market's low, doesn't matter if you think there's going to be an impending recession, whatever. You just stick to that same strategy, and you'll still grow your money over time. If you've got a 20-year horizon, you're going to be just fine here. And you're going to smooth out the fluctuations of the market by doing that, right? You're not going to have as much volatility in your portfolio because you're buying at highs and you're buying at lows as well. And you're probably going to get, and this is an average going over the past like 50 years. If you did that, you'd have around about 10 to 11% on average growth per year. And of course that would compound. So you'd make a lot of money in the course of 20 years. If you're not doing it that way, however, then I would not buy SPY right now. I would only buy it, say, for example, I've picked, this is August 11th right now. August 11th, 6 months from now, I'll buy it again. 6 months from now, I'll buy it again. I'll do it in as equal increments as I possibly can to keep it as level as possible. But if you're not going to do it that way, then I would not buy the S&P 500 at the moment. I still own it. I'm not selling it because I got it at a great price. And if I'm wrong about this, then great. I'm going to make more money, and that's fine. But I just, there's too many unknowns, and we seem to be declaring victory too early. And I want people to be warned. We could be entering into a phase of the market cycle that I and others like to call the "this time it's different" phase. We went through the initial fear, and then the fears didn't turn out to be as bad as we expected. Well, reality didn't turn out so far to be as bad as we expected. So now it could give people way too much confidence, and it could be something that starts to make people think, well, this time it could be different. But we still have 8.7% CPI. We've still got super high inflation. We've still got a long road to that 2 to 3% target inflation that the Federal Reserve has. And I just don't see us getting there without a deep recession. So, I mean, I could be wrong. I hope I'm wrong. But, policy is not going to do it. Politicians don't create jobs. Okay. You and I, the people, we create jobs through our added value to the economic society. Politicians can only move around resources. They don't create new resources. And similarly, they don't create new wealth. They can only move around wealth, right? And money in itself is subjected to the same laws of supply and demand. Currently, with inflation and the way things are right now, we have a textbook example of inflation, by the way. We have too much money chasing too few goods and services. Printing more money does not increase wealth. It only devalues the currency over time. So the 755 page, and Dave's going to kill me for this because I'm getting a little political, but whatever. The 755 page, $700 billion Inflation Reduction Act. This is comparable to trying to fight fires with flamethrowers. Once you realize that just printing more money and handing more money out, spending more money and pushing more money into the economy does not create wealth, it devalues the dollar and eats up spending power. Once you realize that, then you'll understand what I'm saying is true. It's like fighting a fire with a flamethrower. You're just adding more to it. Meanwhile, we have a low 3.5% unemployment level. And that's one of the reasons why people could start to say, well, this time it's different. 3.5% unemployment. Things look rosy. Things look great. We're spending all this money and it doesn't seem to matter. 8.7% inflation. Who cares? We all still have jobs and we're all still thriving. And the stock market's not doing that bad anymore. And, it's just this time it's different mentality. Well, the last time the unemployment level was this low was 1969. And the 1970s wound up being a lost decade for economics and for equities. And the politicians, they tried to, in vain, fight inflation through policies like price controls and more spending and all of that. And it really just put off the inevitable until Paul Volcker came into office and said, you know what, we need to we're either going to put it into inflation and have a recession, or we're going to continuously have high inflation and, have millionaires in this country that can't buy a loaf of bread at some point. And he did the right thing. And he increased rates very, very dramatically, created a recession. And by 1985, we were good again. I'm not certain that we have anybody in office right now, and I'm not certain that the current Fed chair has the kind of cojones. Is that the way you say it? I don't know. You know what? I'm going to put together one day. I'm going to put together all of the things that me and Dave mispronounce. I think it'll be a pretty funny thing to do. But I don't think that he's got the testicular fortitude. That's a nice way of saying it, right? I think that sounds sophisticated. The testicular fortitude. I don't think he's got it. I don't think he's got the testicular fortitude that it takes to do what is needed. I think 50 basis point increases. I don't think it's enough. And I think 8.7%, I think that we are really just ringing the victory bell way too early here. Way too early. This is kind of all I had to say today. This is kind of a short podcast, but my final thought. Let me give you my final thought here. Okay, my final thought is this: I think more deals are coming, and all the pessimism I had on last week's show, all the pessimism that I had on this week's show, I still want to be fully invested in this market. I'm not buying anything right now. I want to be buying things right now, but nothing is showing a particular value to me. As soon as it does, I'll buy. And here's the reason. I said politicians don't create jobs. I said they don't create wealth. But the good news is you and I do. You and I do. the people of this country. And capitalism has done more to raise people out of poverty than any economic system in the history of the world, because it has given us the power to revive ourselves when things are bad and to be resilient. And we're resilient. We're resilient people. In the face of all the bad economic policies that are thrown at us, all of the coercion, all of the crap that is just thrown at us on a day-to-day basis, we continue to thrive. And I don't expect that to end anytime soon. So no matter what policy mistakes the politicians make, no matter what policy mistakes the Federal Reserve makes, we're going to be okay. We have faced much worse than this in the past, and we will come out on the other end. 1970s were a lost decade, but if you would have bought like IBM in 1969, I don't know if it was a publicly traded company at the time. I'm just kind of shooting from the hip right now, but you understand what I'm saying. If you would have bought a great company in 1969, you still had it right now. If you would have held it through the 1980s and geez, the 1990s, man, you would have made a lot of money. That decade of the 1970s certainly would have tested you, but I continue to be bullish, even though I'm negative on the current situation. And that's my final thought. And, if you like this show, I want to encourage you to subscribe to us, hit the subscribe button, head over to Anchor. We've got some questions on there. We want you to answer. You can look at our TikTok too. And I want you to answer the questions. The question is, what company do you want us to cover next? The show would have been a little bit longer if I would have had some answers, but I didn't get any. So go to our TikTok, head over to our Anchor. We really want to be more engaging with our fans. Tell us what you like about our show. Leave an honest review on Apple Podcast. If you don't like us, tell us why you don't like us. If you do like us, tell us why you do. These are all things that will help us be more successful in the future. And we really appreciate everybody that listens on a day-to-day basis. We see the numbers. We see that we have a small so far, but loyal group of fans that listen every episode, and we love you for it. Me and Dave would be doing this even if we had only one fan, but it makes it, or even if it was just us, listening to the show, we would still do it. But we really appreciate it. You guys make this a lot better. It makes it much more enjoyable that people are willing to come and support us by listening to us. So thank you very much. And, rather short episode today. Dave had a situation that he had to deal with that we didn't see coming. And he will be back next week. We plan on recording the next episode probably on Thursday. I've got a lot to do over the next week, so it'll probably be Thursday night, and we will be ready for your Friday drive. Be a full show with me and Dave, a lot more conversation, and he'll be here to rein me in and get me off the politics and all that stuff. And I'm trying to be as bipartisan as I can be here. I just want to explain how economic policy affects stocks and equities and kind of paint the picture of what's happening. I'm not trying to, sway your votes or anything like that, tell you who to vote for or whatever. I'm just trying to paint like the picture that I'm seeing from my perspective. So I hope you understand that. If people disagree with me, it's fine. All right. Have a good night.